I'm Bernard Hickey from interest.co.nz and welcome to the Daily Briefing. Today we're going to talk about the current account deficit and why it's still so big despite an increase in export earnings after the dairy boom and the introduction of the Tui oil field. And then we'll look at GDP, what's happening with the economy. It's a bit like looking in the rear vision mirror, but it's useful to know what's going to happen to interest rates. Now let's have a look at our current account deficit. Some figures came out yesterday that showed our current account deficit fell in the December quarter to 3 billion, and that's slightly better than the 5 billion we saw in September and the 3.5 billion we had in December quarter of last year. What's happening here? Our current account deficit fell to a record low of 15 billion just over 6 months ago. And now it's improved to about 13.8 billion, which is about 7.9% of GDP. A couple of things going on. We've got good export earnings coming in from dairy and from the introduction of the new Tui oil well just off the Taranaki coast. But we've still got a current account deficit problem because of our deficit on our income. This is where foreign investors have put money into New Zealand, or we've borrowed money from foreign investors and we have to pay them dividends or interest payments every year, and that's rising quite sharply, in part because we borrowed so much from foreign investors over the last 5 years or so, about $50 billion. And as interest rates rise, that cost of that foreign borrowing is going to increase, and that's going to make our current account deficit situation that much harder to reverse. So yes, we're doing well on the export front, but because we went on a debt-fueled splurge of spending the last 5 years, our interest payments to foreigners are increasing. We've just seen the latest figures for the December quarter GDP. They've just come in and they show that growth in the quarter was 1% seasonally adjusted. Now this was slightly better than economists had forecast and brings growth for the year to 3.1%. As you can see here, we've had a slight slowdown in growth over the last year or so. But this really is looking in the rear vision mirror, and most people are now looking ahead to what's happening right now. Remember, that December quarter finished 4 months ago, and there's been a significant deterioration in consumer sentiment and in consumer spending as well. But it's worth looking at that snapshot for the December quarter to find out what's happening with our economy. Firstly, the biggest driver of growth was coming from the export sector, and particularly dairy exports, where prices are up sharply. Consumer spending was relatively slow, it was only up 0.5% for the quarter, and we saw relatively strong growth in business investment. But the big picture here is we have an economy that's slowing, that is under extreme stress from the housing sector, where prices are falling. We've got consumer spending under pressure from higher petrol prices and higher food prices, and we've got a relatively strong agricultural sector, in particular the dairy industry, doing very well. What does this change for the outlook for interest rates and perhaps the exchange rate? I suspect not much at this stage. It's a bit too rear vision for the Reserve Bank and for the markets, who really are looking ahead as opposed to 4 months behind. So at this stage, interest rates are on hold, most people would say, at least towards the end of this year, because we have an inflation problem that the Reserve Bank needs to fix. I'm Bernard Hickey for interest.co.nz. That was the Daily Briefing for today. See you on Monday.